Here's something almost nobody tells you about the Roth versus traditional IRA debate. At equal tax rates, the two accounts are mathematically identical. Not similar, identical, down to the penny. So the entire decision, all of it, comes down to a single number, and most people are guessing at it. Today, we did the math on the exact crossover point where each account pulls ahead. The question we're answering is simple to ask and surprisingly tricky to answer. Should you put your retirement money in a Roth IRA where you pay tax now and withdraw tax-free later, or a traditional IRA where you skip the tax now and pay it on the way out? The internet is full of confident, contradictory answers. Roth is always best for young people. Traditional always wins because you withdraw at a lower rate. Pay tax on the seed, not the harvest. We're going to show you that most of these rules of thumb are either wrong or only true under conditions people never check. The good news is that the underlying math is clean. To run it, we'll use the official 2026 IRS numbers as our illustration. The standard contribution limit is $7,500 or $8,600 if you're 50 or older. There are 7 federal tax brackets running from 10% up to 37%. And we'll lean on a simple algebraic identity that, once you see it, changes how you think about this forever. The whole thing reduces to a single comparison: your marginal tax rate today versus your marginal tax rate in retirement. Let's build it up step by step. Let's start with a stat call-out, because this is the single most important and most counterintuitive fact in the entire video. When your tax rate today equals your tax rate in retirement, Roth and Traditional produce the exact same after-tax dollars. Here's why. Picture a Roth contribution. You take your money, you pay tax on it now, then you let what's left grow. In plain terms, that's your contribution times 1 minus your tax rate today times the growth factor over however many years. Now picture a traditional contribution. You skip the tax, the full amount grows, and you pay tax only at the end. That's your contribution times the growth factor times 1 minus your future tax rate. Look at those two expressions side by side. They contain the exact same 3 ingredients. The only difference is the order of multiplication. And multiplication doesn't care about order. 2 times 3 is the same as 3 times 2. So if your tax rate now and your tax rate later are the same number, the two results are identical. The Roth is not magic. It only wins on a difference between those two rates. But here's where it gets interesting. Look at the compound growth curve for both accounts. People assume Roth wins if you have decades to grow because all that growth comes out tax-free. It feels obvious. 40 years of tax-free compounding has to beat the alternative, right? Watch what actually happens. In our equation, the growth factor, the 1 plus your return, raised to the number of years, appears in both the Roth expression and the traditional expression. It's the same term on both sides. So when we ask the question, at what point are these two equal, that growth term cancels out completely. It vanishes from the comparison. Let that land. The time horizon does not change the break-even. The rate of return does not change the break-even. Whether you earn 5% or 9%, whether you have 10 years or 40, the crossover point is exactly the same. The two curves scale up together, identically as your money grows. They only ever separate based on the gap between your two tax rates. This is the part that breaks people's intuition, and it's just arithmetic. So let's name the crossover directly with a side-by-side rate comparison. On one side, your marginal tax rate today. On the other, your expected marginal tax rate in retirement. The break-even is the line where those two are equal. Above that line where your retirement rate is higher than today's, Roth pulls ahead because you're locking in tax at the cheaper rate now. Below that line where your retirement rate is lower than today's, Traditional pulls ahead because you're deferring tax into a cheaper future. And right on the line, it's the tie we already proved. So the real question was never Roth versus Traditional in the abstract. The real question is, do you expect your tax rate to be higher or lower when you retire than it is right now? Everything hinges on that one forecast, and we'll come back to how to actually make it. Now we have to be honest about something the simple proof quietly assumed. Let's put it on a money flow waterfall. A $7,500 Roth contribution and a $7,500 traditional contribution do not cost you the same amount of money. The Roth dollars are after tax. You already paid the tax, so they're worth more per dollar. The traditional contribution, by contrast, gives you a deduction. At a 24% rate, contributing $7,500 to a traditional account hands you roughly $1,800 back as a tax refund. For the comparison to be truly apples to apples, you have to take that $1,800 refund and invest it in a side taxable account. If you do that, the math we showed holds. But here's the behavioral trap. Most people don't invest the refund, they spend it. And the moment you spend that refund, the traditional account is sheltering less of your real money. And Roth quietly wins, not because of tax rates, but because it forced you to save more inside a tax-free wrapper. So whether Roth or traditional wins in real life often comes down to a question about your habits, not a question about math. Let's clear up two misconceptions that pull in opposite directions using a bar chart of how retirement withdrawals get taxed. The first misconception favors traditional. It goes like this: you contribute at your high marginal rate, but in retirement, your withdrawals fill up the standard deduction and the bottom brackets first. So you withdraw at a low average rate, so traditional always wins. There's a real grain of truth here. In 2026, the standard deduction is $16,100 for a single filler. A retiree with no other income pays 0% on that first chunk, then 10%, then 12% on the next bands. But here's the correction, and it's the canonical one from the Bogleheads community. Those low brackets get filled by your base balance first. Your additional contributions come out on top of that base, which means they're taxed at your marginal retirement rate, not the 0% first dollar rate. So you should compare your marginal rate now against your marginal rate later, not against a flattering average. The second misconception favors Roth. The pay tax on the seed, not the harvest line, and we already dismantled that one. Taxing the seed equals taxing the harvest when rates match. Now for the most powerful refinement, and it deserves its own stat call-out. It's called the break-even tax rate, or BETR. Here's the idea. When you can pay the tax bill with money from outside the retirement account, rather than from the account itself, the break-even future rate actually drops below your current rate. In plain English, Roth can win even if your tax rate in retirement turns out to be somewhat lower than it is today. Vanguard ran this on a Roth conversion, converting $300,000, and paying the tax with outside funds produced a break-even future rate of 23%. That's below the current rate in their example. Why does this happen? Because when you pay the tax from outside money, you're effectively moving extra wealth into the tax-free wrapper without using up any of the account. Every dollar of outside money you use to cover the tax is a dollar that now gets to grow tax-free forever. So if you've got cash on the side to cover the bill, the scale tips toward Roth, and it tips further than the naive two-rate comparison would suggest. Before we get to the decision, two structural advantages sit outside the pure rate math, and both favor Roth. Let's show them as a side-by-side rate comparison of lifetime flexibility. First, required minimum distributions. A traditional IRA forces you to start withdrawing money at age 73, rising to 75 by 2033, whether you need the cash or not. Miss one and the penalty is 25% of the shortfall, dropping to 10% if you fix it promptly. A Roth IRA has no required minimum distributions during your lifetime, none, so your money can keep compounding tax-free for as long as you like. And those forced traditional withdrawals aren't just an inconvenience. Late in life, they can push you into a higher bracket, trigger Medicare surcharges, and cause more of your Social Security to be taxed, costs that are completely invisible in a simple two-rate comparison. Second, sheltering capacity. Because Roth dollars are after tax, a maxed-out Roth holds more real, spendable value than a maxed-out traditional at the same contribution limit. So when the rate math is a genuine tie, these tiebreakers lean Roth. So let's turn all of this into a decision framework you can act on. The core rule is one comparison: your marginal rate now versus your expected marginal rate in retirement. If you expect a higher rate later, choose Roth. That's the early career earner, the rising professional, or anyone who believes tax rates broadly rise over time. If you expect a lower rate later, lean traditional, and this is critical, actually invest the tax savings in a side account, or the advantage evaporates. If the two rates look roughly equal, use the tiebreakers and lean Roth for the no RMD flexibility and the tax diversification. Now the concrete thresholds, using the 2026 brackets as illustration. If you're in the 12% bracket or lower, that's single taxable income under about $50,400. Almost always choose Roth. Rates that low are historically cheap, and there's little to gain from deferral. If you're in the 24% bracket or higher and you genuinely expect a lower income retirement, lean traditional and invest that refund. If you're sitting in the 22% bracket, it's a real toss-up, so default to splitting your contributions between both for tax diversification. If you'll be paying the contribution or conversion tax from outside money, tilt toward Roth because of the BETR effect we walked through. And if your income is above the phase-out, around $153,000 to $168,000 for a single filer or $242,000 to $252,000 to $252,000 married filing jointly, the direct Roth closes, but the backdoor Roth, a non-deductible traditional contribution followed by a conversion, bypasses that income limit entirely. One last behavioral rule that overrides the spreadsheet. If you know you won't reliably invest a traditional refund, choose Roth, because it forces more of your real money into a tax-free wrapper. If this made the Roth versus traditional question finally click, do us a favor and hit like and subscribe so the next breakdown finds you. We did the math so you don't have to.